Welcome back, everyone. As we approach year end, we are back with a refresher session covering updates for financial year end reporting, including for financial services sector. Once again, we welcome Vishal Divadkar, partner and head audit and assurance MSK and Associates, and Swapnil Kale, partner and leader financial services audit and assurance MSK and Associates thereafter to share year end financial reporting reminders. Over to you, Vishal.
Thank you all and welcome to another episode of Insync. Following our theme around this time of the year, we would focus on key financial reporting and regulatory matters applicable for the ensuing year end. In this session, I intend to do a quick reminder and refresher on few Ind AS amendments applicable for the March 24 financial statements, the new audit trail compliance requirement for management and auditors, and also highlight certain big ticket SEBI updates that have been issued through the year. I will also be joined by my colleague Swapnil Kale, who leads our financial services audit practice, to talk you through certain specific sector related updates relevant for the year end. I'll begin with the India's amendments. While there are a few amendments and adoption of standards in the works, even globally, specifically for FY 23-24, there haven't been many new developments. The MCA issued on 31st March 2023 certain key amendments that have been summarized on this slide. Starting with material accounting policies, the rationale for introducing the amendment to India's one was to encourage entities to provide entity specific accounting policies and not just have standardized boilerplate information reproduced from the standard. The expectation here is that there will be a streamlining and decluttering of the financial statements. The amendments provide that accounting policy information is material only if, when considered together with other information included in the financial statements, can reasonably be expected to influence decisions of the primary users. It may be noted that an entity's conclusion that an accounting policy information is immaterial does not affect the related disclosure requirements set out in the India's accounting standards. For example, an entity may conclude that property, plant, equipment for a services industry may not be a material accounting policy. However, if material, the entity must still disclose the relevant information required by India's 16 in the notes to the accounts. So, where does one start with material accounting policies? Each significant accounting policy should be reviewed and could be removed unless it relates to an accounting policy choice available as per the accounting framework. For example, carrying value of subsidiaries, which you could do at cost or fair value as per India's 27 inventory valuation method. If the policy has changed during the year, one needs disclosure. If the policy explains a complex transaction, let's say a business combination or a derivative accounting, or it simply relates to an area of significant judgment or assumption, one would expect that policy to be reproduced in the financial statements. For example, under India's 110, evaluation of control could involve significant judgment due to factors like de facto control. Shareholder agreements could include clauses which either demonstrate that control exists or indicate that control may not exist, where substantive rights could be held by the other shareholders. So the accounting policy would be expected to bring out such nuances on the basis of the principles applied for consolidating the subsidiary and not just reproduce the wording from the standards. Overall, it would be expected that the number of policies would reduce and only that those that are really pertinent to the users would be maintained. Moving on to the amendment to Ind AS 8, the erstwhile version of Ind AS 8 did not provide a definition, believe it or not, for definition of accounting estimates. Accounting policies, however, are defined, but the standard defined the concept of a change in accounting estimate. In the amended standard, the accounting estimates are defined as monetary amounts in financial statements that are subject to measurement uncertainty. That is, the accounting policy may require that such items be measured at monetary amounts that cannot be observed directly and must instead be estimated. In such cases, an entity needs to develop an accounting policy to achieve the objective set out in the accounting policy. Accounting estimates typically involve use of judgments or assumptions based on latest available reliable information. I would not expect the amendments to have a material impact on the entity's financial statements. However, the amendments will provide helpful guidance for entities in determining whether changes are to be treated as changes in estimates, changes in policies, or in fact errors. Moving on to the last amendment to Ind AS. So Ind AS 12 has been amended to clarify the scope of the initial recognition exemption. It is now clarified that the exemption does not apply to the initial recognition of an asset or liability, which at the time of the transaction gave rise to equal taxable and temporary deductible temporary differences. This happens mainly in situations such as accounting of leases or asset retirement obligations. Many entities have applied the index in the manner that it was expected to be, but this may result in a change for certain entities. For example, like I said, an entity has entered into a leasing transaction. Under Ind AS 116, it should have recognized a right of use asset and a lease liability at the commencement date of the lease. Under the Income Tax Act, the entity will be eligible for the tax deductions only when it makes lease payments. In such cases, apparently two views were being followed. One where one would apply the exemption separately to both asset and liability. Thus, no deferred tax asset or liability were recognized, and the tax impacts were getting recognized in the P&L in the period they were incurred. However, consider the second option was to consider the asset and liability together as part of an integrally linked transaction for deferred tax purposes. The consequence is that the initial recognition exemption was not applied and deferred taxes were in fact recognized, which is the correct way of accounting deferred tax under Ind AS 12. Moving on to the audit trail requirement, which is quite a unique concept to India. Globally, no such similar reporting obligation exists, and after much debate over the past 2 years, this has finally been made applicable for all companies from the current financial year. So, I'd like to believe that most companies should have by now taken stock and addressed any gaps in their accounting softwares in order to comply with this requirement. This slide is only a reminder of the key requirements and a refresher in case you are yet to embark on this journey. So, as you're aware, the rules require that each company to use accounting software that can record the audit trail to capture the change history, including the who, what, and when for all relevant transactions impacting books of account. So for the financial year FY 23-24, every company which uses accounting software for maintaining its books of accounts shall use only such accounting software which has these features of audit trail. For each and every transaction, creating an edit log of each change made in the books of account, along with the date when such changes were made, and ensuring that the audit trail cannot be disabled. Since it is management's responsibility for maintaining books of account, they are thereby also responsible for ensuring selection of the appropriate accounting software for ensuring compliance with this new regulation, including those related to retention of audit logs. The auditor in turn has to report whether the company has used such accounting software which has the feature of recording audit trail, edit log facility, and the same has operated throughout the year for all transactions recorded in the software, and that the audit trail feature has not been tampered with, and finally, whether the company has preserved the audit logs for the requirements as per the statutory law for record retention. The auditor is required to comment on the above matters both in case of reporting on standalone financial statements and also CFS. The accounting software may be hosted and maintained in India or outside of India, or may be on premise or on cloud, or subscribed to as SaaS or service software as a service. In case of accounting software supported by service providers, the company's management and the auditor may in turn consider using independent auditor's report, such as the SOC Type 2 assurance report, to comply with the audit trail requirements. To note, unlike reporting on IFC, Rule 11G requires auditor to report that the feature of recording audit trail facility has operated throughout the year for all transactions recorded, and not just at the year end. There has been some debate on what constitutes books of account. Any software that maintains records or transactions that fall under the definition of books of accounts under the Act will be considered as accounting software for this purpose. The Companies Act has a fairly comprehensive definition for books of accounts and includes records maintained in respect of all sums of money received and expended, all sales and purchases, assets and liabilities of the company, and the cost records per Section 148. Various standard softwares do have this feature, but the key for management would be to evaluate whether existing legacy in-house developed softwares can accommodate this requirement. Mind you, this applies to all companies. So the database and storage architecture of certain softwares may have limitations, especially those built in-house. It is advisable for companies to seek external help, both from an IT infrastructure standpoint and also an audit standpoint. There was recently the revised implementation guide issued by the Institute that contains certain practical FAQs, which provides helpful guidance on certain situations and also clarifies auditors' reporting responsibilities in certain situations. Whilst the implementation guide is for auditors, it does reinforce the requirements of the law. So this slide captures a few actions that would be expected both of the company and the auditors. Given this is a new area, a lot of effort would need to take place prior to the year end. And as with all new legislation, this will also evolve, and only time will tell how this has been embraced by stakeholders. But in summary, company would need to list down what constitutes books of account and the coverage for accounting software purposes, design and implement specific internal controls, predominantly IT controls, we would imagine, put in place controls restricting access so as to ensure that the audit logs are not tampered with. Finally, ensure backup of the audit trail, which is required to be retained as per the statute for a minimum period of 8 years. On the other hand, auditors will also enhance procedures. They would be expected to involve IT experts to test the audit trail compliance, such as the configuration, whether the feature of the trail has operated effectively through the year. In case of third party software or outsourced software, whether the company has obtained the SOC Type 2 assurance report for evaluating compliance. And then finally, also considering basis the outcomes of their procedures, whether this has any impact on the overall financial control, internal financial control opinion that is issued along with the main audit report. Moving now to certain updates that SEBI issued through the year, there have been quite a few, but what we've done is just capture some of the relevant ones from a financial reporting standpoint, and also those that the companies have needed to sort of change their processes in order to ensure compliance. So, starting with related party transactions, this has been a hot topic for a few years now across various stakeholders, right from standard setters to tax authorities to the investor protection community. During the year, SEBI introduced further amendments in this regard and reiterated the importance of empowering shareholders in terms of reviewing and approving RPT transactions. The amendments issued by SEBI not only aim to widen the gamut of what constitutes related parties, but also strengthen the related approval and disclosure processes to assist audit committees and shareholders to make more informed decisions with respect to related party transactions. The key changes, very quickly to highlight, the scope of RPT themselves has been enlarged. So, in order that disclosures are not evaded through innovative structures, the amended RPT definition now includes all promoter and promoter group companies, irrespective of the shareholding. Those that are not part of the promoter group but where shareholding exceeds 10%, which is with effect from 1st of April 23, are also considered to be related parties. As a result, a careful consideration would be needed where there are entities controlled by such persons or where two or more persons act in concert, etc. While SEBI may provide further clarifications, large groups with complex structures may require a more detailed evaluation and a continuous evaluation. With respect to transactions with subsidiaries, further transactions with subsidiaries of listed companies or any transactions between the subsidiary and its related party prior approval of the audit committee of the listed company would be mandatory, whether this subsidiary is based in India or outside. Additionally, all subsequent material modifications to RPTs will also require prior approval of the audit committee. As per the amendment, the threshold for RPTs requiring a prior approval of the audit committee has been reduced. The new threshold now is 10% of the standalone turnover of the subsidiaries, which is applicable now from 1st of April 23. The threshold of 10% is fairly low in comparison to the consolidated turnover criteria that was applicable in the past. This is likely to, of course, increase the number of transactions to be approved by an audit committee. This means added onus on independent directors. In certain cases, prior approval of shareholders has been mandated for material related party transactions and material modifications to such transactions. The amendments have now harmonized the requirements of the listing regulations with those prescribed in the Companies Act. Accordingly, as per the amendments, the audit committees of companies will now need to define what constitutes a material modification and include it in the policy on dealing with RPT as prescribed under the regulation. The materiality threshold prescribed now is for all transactions during the year exceeding 1,000 crore or 10% of consolidated annual turnover, whichever is lower, will require prior approval of shareholders. Thus, entities will now need to identify and plan related party transactions during a period and take necessary approvals from shareholders before entering into such transactions. Listed companies may need to hold additional meetings for new transactions that fall in the ambit of related parties and ensure such meetings and approvals are sought in a timely manner. Moving on to BRSR. So in July 2023, based on the recommendations of the ESG Advisory Committee and pursuant to public consultation, the SEBI board decided to introduce disclosures and also a requirement for assurance over a BRSR. This was called the BRSR Core, which was a subset of BRSR consisting of certain key performance indicators and metrics under the ESG attributes. So from FY 23-24, the top 1,000 listed companies by market cap shall make disclosures as per the updated BRSR formats as part of their annual reports. Further, listed companies shall now mandatorily undertake a reasonable assurance exercise as per the glide path specified by market cap, and engage an independent auditor or an assurance provider to provide such assurance. Um, this is applicable for the top 150 listed companies for the current financial year itself, and this over the next 3 years covers all top 1,000 listed companies by market cap, where mandatory reasonable assurance opinions would need to be obtained and included in the annual reports of such companies. The listed company shall ensure that there is no conflict of interest with the assurance provider appointed for assuring such BRSR core. There have been FAQs issued as well by SEBI to clarify who can be appointed as the assurance provider and the expectations around the independence compliance of such assurance providers as well. So moving to Regulation 30, material events or information that is applicable for listed companies, wherein they need to provide certain disclosure of such events to the stock exchange in accordance with Part A of the LODR, Schedule 3 of the LODR regulations. Part A in turn has two paragraphs. Para A, which includes deemed material events which are required to be disclosed regardless of any materiality threshold, and para B, which needs to capture events that are material basis certain quantitative and qualitative thresholds, again guided by the regulator in terms of what constitutes a material event. Um, SEBI, through a notification, then issued various amendments with respect to disclosure of such events or information, and those amendments broadly covered the following: A, the events that should be disclosed, so that's been enhanced now. The timeline for disclosure of material events and guidance on when an event can be said to have occurred. Again, specific guidance has been provided on these elements. And finally, the manner of determination of materiality for the events covered in para B. These amendments were effective from 15th of July 2023. The slide highlights a few of the key changes to para A. These are additional mandatory disclosures that have been included as part of the recent amendment. So these need to be disclosed regardless of whether they are material or not. So some of the items that have been included include sale of stake in associate companies, action taken or orders passed by any regulatory, statutory, enforcement authorities, fraud, defaults by the listed company, changes to senior management, disclosure of resignation letters, and reasons of resignation for KMPs. As you would have noted, a lot of companies have been issuing a number of such disclosures to the stock exchange that has been evident over the activity over the past few months. Furthermore, if it's been clarified that if the MD or the CEO of a listed entity was undisposed or unavailable to fulfill the requirements of his role for more than 45 days, this must be disclosed to the stock exchange as a deemed material event. This slide captures the requirements of para B, which are driven by the materiality criteria. Materiality can be both quantitative and qualitative based on guidance provided by the board. Also, there is guidance provided on the timelines prescribed for such reporting. For the paucity of time, we will not get into the specifics of the timelines and the materiality considerations, but very quickly for various new events information that are now covered as part of para B, arrangements for strategic technical manufacturing or marketing tie-ups, or adoption of new lines of business, closures of units, divisions, or subsidiaries, for frauds or defaults by employees of listed companies that may have an impact on the company. Um, Pendency of any litigation or dispute or the outcome thereof, which may have an impact on listed companies, also now a para B event. Whilst the disclosure of the litigation or dispute has been retained in para B, the disclosure of the regulatory action has been shifted from para B, subject to the materiality threshold, to para A, wherein there is no prescribed materiality threshold for disclosure. So with that, we end the session on key updates for the year end. I'll now hand over to my colleague Swapnil, who will take you through certain sector specific amendments and watchouts for the coming year end. Thank you.
Thank you, Vishal. Now we will cover the updates from the Reserve Bank of India and the updates from the Insurance Regulatory Development Authority of India. First, we will cover the updates from the Reserve Bank of India. The Reserve Bank of India on 19th December 2023 issued a notification, Investments in Alternate Investment Funds, which impose restrictions on all regulated entities, that is REs, with respect to their investments in the Alternate Investments Funds or AIFs. This circular prohibited all REs, including banks, cooperative banks, non-banking finance companies, and all India financial institutions from making investments in AIFs if the AIFs has made any investment into a debtor company. Debtor company has been defined as a company in which the RE currently has or previously had a loan or investment exposure any time during the preceding 12 months. If investment already exists, the regulated entity is required to divest that investment or exit from that investment within a period of 30 days from the date of issuance of the circular or ensure 100% provision against the against the investment in the AIF. So this circular had a long-lasting impact on the industry. Flow of funds from the regulated entities to alternate investments fund have stopped completely. There was a divestment pressure on all the regulated entities to divest their investments in REs within a period of 30 days. The circular is very stringent. If REs are not able to divest within a period of 30 days from the issuance of the circular, then 100% provision against the investment in AIF was warranted. A significant portion of the contribution to AIF in India are banks, NBFCs, and other regulated entities. AIFs are finding it difficult to raise capital commitment. This will lead to reliance on foreign institutional capital going forward. Now let's look at the another important circular issued by the Reserve Bank of India during the financial year with respect to consumer credit and bank credit to non-banking finance companies. The RBI issued a circular on November 16, 2023 on regulatory measures towards consumer credit and bank credit to non-banking finance companies. In its circular, the RBI referred to Governor's statement on October 6, where he flagged the high growth in certain components of consumer credit and advised banks and non-banking finance companies to strengthen their internal surveillance mechanism, address the built-up of risk, if any, and institute suitable safeguards in their own interest. It is worth highlighting that high growth in consumer credit and increasing dependency of non-banking finance companies on banks' borrowing were also highlighted by the governor in the interaction with the MDs and CEOs of major banks and large NBFCs in July and August 2023. Some of the key highlights of this circular are as follows. The circular requires to increase risk weights for consumer credit held by banks and non-banking finance companies, increasing risk weights for banks' exposure to non-banking finance companies, setting exposure limits for consumer credit, particularly unsecured consumer credit, and reckoning top-up loans backed by depreciable movable property as unsecured exposure. So there is an increase in risk weight by 25 basis point from 100 to 125%, and in some cases from 125% to 150%. We believe it is a step in the right direction to curb the high growth in unsecured personal loans and credit cards. However, the increase in risk weights will also affect the capital adequacy ratio of the lenders, thereby making them set aside more capital for such loans. Majority of the online lending apps procure capital from other non-banking finance companies or banks. Non-banking finance companies whose capital mix is skewed towards bank borrowings will suffer a dual impact. First one, they will have to set aside additional capital for lending in the unsecured category, and secondly, the bank who are lending to them also have to set aside additional capital. This will lead to higher cost of capital and maybe increase in the interest rates. Another important circular which was issued by the Reserve Bank of India towards the end of the financial year, that is on February 27, 2024, is with respect to filing of supervisory returns. The RBI issued a detailed master directions on 27 February to reduce the compliance burden of banks and non-banks on issues related to filing supervisory returns and risk mitigation. These directions aim to create a single reference for all supervisory returns and to harmonize the timelines for filing the returns. Some of the requirements of this circular are as follows. All audited returns of commercial banks should be filed within 5 working days from the date of signing of the auditor's report for the year ended March 31. In the earlier guidelines, the timelines were used to be 7 days. So now from 7 days, it has come to 5 days from the date of signing of the auditor's report and the financial statements. Second one, to file a balance sheet analysis within 5 working days from the date of signing the auditor's report. Again, 5 days for balance sheet analysis. The next one, the interest rate sensitivity returns for all months shall be submitted within 15 days for commercial banks. There are also other requirements of this circular which required to be complied with by all the regulated entities. Now let's look at another important circular issued by the Reserve Bank of India. On 14 January 2022, the Reserve Bank of India issued a discussion paper proposing revisions to the existing norms governing the classification, valuation, and operation of investment portfolios held by the commercial banks. The RBI has now taken the next step by issuing the master directions on classification, valuation, and operation of investment portfolio of commercial banks Direction 2023, which was released on September 12, 2023. These new directions mark a significant development in how commercial banks manage and account for their investment portfolios. According to the new directions released on September 12, banks will have to classify their investments, except investments in their own subsidiaries, joint ventures, and associates, into three categories from the next financial year, that is, available for sale, held to maturity, and a new category called the fair value through profit and loss, or FVTPL, has been introduced. There used to be an existing category which is held for trading that will become a subcategory of fair value through profit and loss, or FVTPL. The central bank has said this in its press release. So when these directions are applicable with effect from April 1, 2024. That is the next financial year. Now let's look at some of the important highlights of this circular. Classes of investments. As discussed, investments will be classified into held to maturity, available for sale, and fair value through profit and loss. Held for trading will be a subcategory of FVTPL. For held to maturity investment class, it will be based on an amortization principles. The recognition of income will be on yield basis, and fair valuation is not required. In case of available for sale, the cash flow has to meet the SPPI test, and it is required to be fair valued on quarterly basis. Any fair valuation gains and losses will go to AFS reserve until the investments are disposed of. The next category, fair value through profit and loss. In case of held to maturity, in case of held for trading class, it has to be fair valued on daily basis. Other FVTPL investments, for all investments which do not qualify as held for trading or available for sale or held to maturity, is required to be fair valued at least quarterly. Any gains and losses from the FVTPL category are required to be recognized in the profit and loss account. Considering this circular is applicable from 1/4/24 and investment constitute a significant portion of bank's balance sheet, we urge all commercial banks to do a thorough analysis for classification and valuation of investments. There will be impact on the disclosures also. There will be also an impact on how banks decide to invest in different classes of investments. Some more updates from the Reserve Bank of India. This is with respect to guidelines on guaranteed losses in digital lending. In the past, the Reserve Bank of India issued guidelines on digital lending on September 2, 2022 that are applicable to all regulated entities. The REs are required to ensure that the lending service providers and digital lending app that are part of their outsourcing agreement are in compliance with the guidelines of that circular. However, those guidelines did not stipulate the regulation for default loss guarantee, or DLG. Consequently, on June 8, 2023, the Reserve Bank of India issued guidelines with respect to default loss guarantee related to digital lending. Another important update from the Reserve Bank of India is with respect to Green Deposit Framework. On April 11, 2023, the RBI issued a framework for acceptance of green deposit. The aim is to allow the regulated entities to enhance their fundraising capabilities and focus on dedicated funds towards sustainable products and activities. The framework is effective from June 1, 2023. This framework is applicable to commercial banks, small finance banks, non-banking finance companies, and housing finance companies. Now let's look at the update from Insurance Regulatory Development Authority of India. The Insurance Regulatory Development Authority issued guidelines with respect to remuneration of directors and key managerial personnel, that is KMP, of the insurer. These guidelines require the insurer to complete the process of framing or reviewing the remuneration policies within 3 months from the issuance of these guidelines. Further, these guidelines also prescribe the disclosure requirements for insurers in their notes to accounts forming part of the financial statements. With this, we end the update from the Reserve Bank of India and IRDA. With these updates, we end our today's Insync session. We would like to thank you for your patient hearing. Looking forward to see you next time. Thank you.